When Warren Buffett speaks, the world listens. His words echo far beyond Wall Street, reaching investors, business leaders, and everyday people across the globe. Few voices in finance command such universal respect and attention. He's not just rich, he's the Oracle of Omaha, a legend who built his fortune through patience and common sense, not risky bets. Buffett's journey from a small-town boy with a paper route to one of the world's wealthiest individuals is a testament to the power of discipline and long-term thinking. His approach? Buy great companies at fair prices and hold them for decades. While others chase trends or try to time the market, Buffett focuses on businesses with strong fundamentals and trustworthy management, believing that time in the market beats timing the market. This simple philosophy transformed Berkshire Hathaway from a failing textile mill into a global powerhouse. Under Buffett's leadership, the company grew into a conglomerate owning railroads, insurance, energy, and iconic brands, all built on steady, compounding growth. Buffett's words matter because he's mastered the art of compounding and discipline, thriving through crashes and booms alike. He's weathered every financial storm, proving that patience and rationality can outlast panic and speculation. He avoids fads, studies fundamentals, and communicates in plain English. Buffett's annual letters are legendary for their clarity, honesty, and wisdom, making complex financial ideas accessible to everyone. His famous rule, never lose money, never forget rule number 1. This mantra isn't just a catchphrase, it's the foundation of his entire investment philosophy, reminding us that protecting capital is more important than chasing quick profits. For Buffett, success is about avoiding big mistakes, not chasing big wins. He believes that staying out of trouble is the surest path to long-term wealth, and that discipline is more valuable than daring. When he warns of trouble, it's not hype, it's experience talking. Buffett's caution comes from decades of observing market cycles, learning from both triumphs and failures. He's seen bubbles, crashes, and the dangers of unchecked greed. His perspective is shaped by history, and he knows that markets can turn quickly when fear or greed take over. So when Buffett issues a warning in August 2025, the world pays attention. What does he see that we don't? Is it another bubble, a brewing crisis, or a rare opportunity? Let's find out what the Oracle of Omaha is trying to tell us and why his insights could matter more now than ever before. Imagine a soap bubble, delicate, shimmering, and growing ever larger as you blow more air into it. A financial bubble is much the same. It expands, becoming more impressive and more fragile with every passing moment, until, inevitably, it bursts in a spectacular instant. This happens when the prices of assets like stocks, real estate, or even cryptocurrencies soar far beyond what they're truly worth. The rise isn't based on solid business fundamentals, but on wild speculation and the hope that prices will keep climbing. History is littered with famous bubbles. Take the Dutch tulip mania of the 1630s, for example, when rare tulip bulbs became so valuable that some sold for more than entire houses. People traded fortunes for flowers, believing the craze would never end. People staked everything they had, convinced that prices could only go up. But when reality set in, prices crashed almost overnight, wiping out life savings and leaving many in financial ruin. Bubbles are fueled by powerful stories and collective beliefs. Phrases like, "this time is different," or "it can only go up," echo through the markets, convincing even skeptics to join the frenzy. Soon, FOMO, the fear of missing out, takes over. Rational thinking fades, replaced by a rush to buy before prices climb even higher. But eventually, reality catches up. Sometimes it's a small event, a piece of bad news, or just a shift in sentiment that pops the bubble. Panic spreads quickly, and prices collapse as everyone rushes to sell. The same emotions that inflate bubbles, greed, excitement, and euphoria, suddenly flip to fear and panic on the way down, creating a dramatic reversal of fortune. Recognizing this emotional cycle and understanding the warning signs is crucial if you want to protect yourself from the next big pop. Legendary investors like Warren Buffett have seen these patterns play out time and again. They know that bubbles are part of the market's history and its future. Every bubble, no matter how big or small, eventually pops. The only real question is when, and whether you'll be ready. So, are we in a bubble right now? Only time will tell, but history suggests it pays to be cautious. To understand Buffett's warning, look back at the dot-com bubble of the late 1990s. The internet was new, and any company with .com in its name attracted wild speculation, regardless of profits or even products. Stock prices soared, traditional metrics were ignored, and day trading became a national obsession. Buffett refused to join the frenzy. He stuck to businesses he understood, like Coca-Cola, and was mocked for missing out. But when the bubble burst in 2000, the Nasdaq crashed nearly 80% and fortunes vanished. Companies like Pets.com disappeared overnight. Buffett's caution looked wise in hindsight. The lesson: even revolutionary ideas can't defy financial gravity. A great story isn't always a great investment. Price matters. Hope is not a strategy. After the dot-com crash, the next bubble formed in real estate. Homes, once seen as safe, became speculative assets. Easy money, risky loans, and the belief that housing prices only go up fueled a nationwide mania. People bought multiple properties just to flip them, while banks packaged risky mortgages into safe investments. Warnings were ignored, until interest rates rose, payments spiked, and defaults surged. Home values plunged, leaving millions underwater and triggering a global financial crisis. The lesson: even the safest assets can become dangerous when driven by debt and speculation. Narratives can blind us to risk. When everyone believes prices can't fall, that's when they're most vulnerable. Bubbles burst no matter what the asset is. Are we repeating the same mistakes? August 2025. The world's financial markets are at a crossroads, and few people realize just how precarious things have become. Warren Buffett's latest warning isn't about a single sector like tech stocks or housing. This time, his concern is much bigger. It's about everything. He's sounding the alarm on a risk that stretches across the entire financial landscape. For years, central banks kept interest rates at historic lows, and governments pumped trillions into the economy. This flood of cheap money and relentless stimulus has inflated prices across the board: stocks, bonds, real estate, cryptocurrencies, even collectibles like art and rare cars. Almost every asset class has soared regardless of its underlying value. That's what experts now call the everything bubble. It means nearly all assets look expensive at the same time. But why has this happened? With interest rates so low, investors were pushed out of safe havens and into riskier bets, chasing returns wherever they could find them, often ignoring traditional measures of value. Unlike past bubbles, which were fueled by wild optimism or speculative mania, this one is driven by a sense of there is no alternative. Investors aren't necessarily excited; they feel trapped with few safe places to put their money. Buffett's concern is clear: people are being forced into risk, not drawn to it by opportunity. The danger is building quietly, beneath the surface. If interest rates stay high or rise even further, the fragile foundation holding up these inflated prices could quickly crumble, exposing the vulnerabilities everywhere. Suddenly, safer assets like government bonds would become attractive again, and money would start flowing out of riskier bets at a rapid pace, potentially triggering a domino effect that could ripple through the entire global economy. The danger isn't isolated to one market or country; it's everywhere, woven into the fabric of the financial system. The bubble is the air we breathe, invisible but all-encompassing, shaping every investment decision. The question is, are we truly prepared for what happens if this everything bubble finally pops? The consequences could be far-reaching, affecting not just investors but everyone. Why don't we spot bubbles until they burst? Human psychology. We crave safety in numbers and hate missing out. When everyone's getting rich, it's hard to stay cautious. FOMO and social proof override logic. Media hype and stories of easy money fuel the frenzy. We invent narratives to justify rising prices and ignore warning signs, confirmation bias at work. Buffett's genius is resisting these urges. He uses his inner scorecard, judging decisions by his own principles, not the crowd. He knows markets are emotional in the short term, rational in the long run. Discipline and patience are his edge. That's how he survives bubbles. And you can too. So what does Buffett advise in a world of bubbles? First, avoid debt-fueled speculation. Leverage can destroy you when markets turn. Live below your means. Financial security starts there. Second, focus on value and quality. Own great businesses with durable advantages, not just hot stocks. Think brands, network effects, and consistent profits. Third, demand a margin of safety. Never overpay. Buy at a discount to real value. This protects you from mistakes and bad luck. Fourth, cultivate the right temperament. Investing is about emotional control, not IQ. Ignore daily noise. Think in decades, not days. Don't chase trends or panic in downturns. Combine patience, discipline, and quality, and you'll build a financial fortress. Buffett's advice isn't about timing crashes, it's about surviving them. Prepare, don't predict. Buffett's 2025 warning isn't a call for panic, it's a reminder of timeless investing truths. Bubbles are fueled by stories that this time is different, but the laws of value always win. Focus on real business value, not hype. Avoid leverage. Keep cash for safety and opportunity, and invest in what you understand. Demand a margin of safety in every purchase. Let your investments compound with patience. True wealth comes from owning productive assets for the long run, not chasing fads. Buffett's message: resilience beats prediction. Prepare for uncertainty, don't bet on certainty. Humility and common sense are your best defenses. In a world obsessed with easy money, patience and value are your anchor.